set for their strongest quarter in 17 years. But inflation fears are taking the joy out of the gains in Japan as the yen falls to its weakest level since 1986. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis.
The meeting in Doha is going to be perhaps important, perhaps not. We're going to find out. But we're winning militarily. It's almost won militarily, I would say. And it's really very simple. It's the denuclearization of Iran.
President Trump declining to say whether new talks with Iran could lead to a breakthrough. Meanwhile, Tehran reiterates that it wants to maintain control over the Strait of Hormuz. Ahead on the show, Rystad Energy Vice President Lin Ye will break down oil's cost hurdle and what must happen before flows normalize through the strait. And geopolitical fragmentation is widening the gap between the market winners and losers. Schroders head of multi-asset income, Dorian Carrell, joins us to discuss where investors can still find yield. The yen is at its weakest level against the dollar since 1986. That's a milestone, sending traders on high alert for intervention. The last time the yen was at this level, it was going in the opposite direction, midway through a massive and years-long rally. Now, though, the yen is sliding as Japan tries to find its way out of a generational economic funk. The Bank of Japan ended its negative interest rate policy in 2024, but expectations of a revival in the currency have not materialized. Finance Minister Satsuki Katayama says Tokyo is ready to act on the yen at any time. Traders are now on watch for any signs of authorities stepping in after a record intervention in late April. Bloomberg MLive strategist Mark Cranfield joins me now. Forget about intervention. They didn't work the last two times. What now?
Well, they're probably just going to have to wait until the market gets tired of shorting the yen, which at some stage they probably will. Yen positioning is extremely large already, and at some point traders may naturally decide it's time to take some profit on that, which might be triggered by a slight fall in US yields. That hasn't happened yet, but if it does, of course, that would be a very good reason for traders in the foreign exchange market to pare back. And that's been one of the key factors over the past few months, is that US short-term yields have risen quite sharply, particularly since the war in Iran started. Nothing has happened on the Japanese side, so that gap has got wider and wider. That favours the US dollar. It's not just against the yen. We're seeing pretty broad spread US dollar strength against other Asian currencies.
Like the won as well.
And major currencies as well. I mean, look where the euro is and the pound as well. They're fallen also. So it's not just the yen story, but of course we're signalling that out because traders are thinking that the Japanese are not really doing as much as they could do to try and reverse the yen. And a lot of that comes down to the Bank of Japan action. Recently, Bank of Japan people have made it quite clear they think the neutral rate is around the 2% level, and yet short-term interest rates are at 1%. So you have a big disconnect there. You have a big gap between where rates should be and where they actually are, and there's no rush for the Bank of Japan to get to that point. Traders can see that. They can see on the other side there's a risk that the Federal Reserve may even raise interest rates this year. So things are really stacked against the Japanese currency until you get a situation where the Japanese authorities say, yes, it's time to get interest rates up to a level that helps the currency and maybe intervene at the same time. Not much is going to happen.
And as long as the Fed remains hawkish, it's going to be really hard for the BOJ. I'm just wondering as well, when you take a look at the broader market, we've seen a massive rally in tech. What's the story there as we wrap up the second quarter?
Well, what you've seen is one of the big themes is the chip makers, the people like the Samsungs, the SK Hynix, Micron in the United States, Nvidia. They seem to be able to sell their products at almost any price. There's insatiable demand for these chips that go into AI products. And while that's happening, they can mark up the prices. There's so much demand for it, they can hardly meet the incredible demand. And on the other side, you're seeing the hyperscalers are spending so much money. So you've almost got a cash transference, massive investment by the hyperscalers, and that money, a lot of that is flowing towards these chip makers. $1 trillion on either side over the next few years is estimates that some people see. So as long as that goes on, the profitability of these companies will be great. We're probably going to see in this quarter that profit numbers from these kind of companies is still extremely good, and that will probably revive the markets as we go into July, a fresh month, new quarter. People will be excited about that. Eventually, there'll be a disconnect between the two. The chip makers won't be able to keep on producing those kind of profits, and we may need to scale back on the hyperscale. That isn't a scenario for right now. People seem to be happy with what they see, and we'll probably see a reasonable start to the third quarter.
Keep a watch on that. Bloomberg M Live strategist Mark Cranfield there for us. Well, oil prices drifting lower today ahead of expected talks between the U.S. and Iran in Doha. But conflicting signals from Washington and Tehran are casting doubt over the next phase of negotiations. Earlier, a top Iranian official reiterated the country's determination to maintain control over maritime traffic through the Strait of Hormuz. Middle East correspondent Aber Abu Omar joins us from Dubai. And Aber, Iran's message is pretty clear. It wants control the Strait of Hormuz with or without Oman.
Good morning, Haslinda. Yes, you're right. An unwavering position, really, for Iran since the start of this war, but we keep getting these messages reiterated. The latest came from the Deputy Foreign Minister, Qasem Gharib Abadi, who said that Iran will maintain its control over the Strait of Hormuz with or without the help of Oman. Now, Oman controls the other side of the Strait of Hormuz, Haslinda, and since the start of the war, really, there have been talks about both countries taking a hold of the strait going forward, starting to actually toll it once the 60-day negotiation phase between Iran and the United States ends. We've heard from several officials in Iran saying that once the 60-day period is over, we're going to start seeing tolls or fees starting to get charged to ship owners in the Strait of Hormuz. And so Iran's position continues to be solidified through officials saying that with or without the help, they will continue to bring up the topic of tolling the Strait of Hormuz. Now, Omani Sultan met with Emmanuel Macron of France yesterday, and they both reiterated that the Strait of Hormuz has to remain free of charges. The freedom of navigation needs to stay, but it's unclear just how much Iran is willing to shift its position really on what it wants to do to the Strait of Hormuz. Marco Rubio, the state secretary in the United States, last week when he was visiting GCC countries, said that the notion of charging the Strait of Hormuz is unacceptable. So this remains a key contentious issue between the two parties, along with several other issues, not to say the nuclear component in those negotiations between Iran and the United States, and the frozen assets and the oil sanctions. And now we're seeing the Strait of Hormuz emerge as yet another sticking point where Iran doesn't seem like it is willing to let up its power over it.
It does feel like we're back to square one. Aber, meantime, oil tankers still sailing through Hormuz despite the attacks. Traffic has reduced, but not stopped.
Yeah, you're right. And according to our energy team's coverage, we're seeing, this is according to ship tracking data, we're seeing a trio of inbound ships through the Strait of Hormuz coming back. We're seeing 2 ships going out. We're seeing movement in the Strait of Hormuz. Now, our teams have also spoken to ship owners. 5 of them, at least, have said that they're treading with caution, but that they're still moving forward. So we're seeing a little bit more caution. It's unclear if ship owners are treating this as a geopolitical one-off, or if this is going to be the status quo. And Haslinda, this is really starting to become the question. Is this the new reality for the Strait of Hormuz? Is this the new reality for water or maritime navigation? And this is a question that is confronting a lot of these ship owners and also countries in the GCC, countries in the EU, and the United States itself are starting to get really worried about the notion of a Strait of Hormuz that is not free of charges. And so we're seeing movements still continue through the Strait of Hormuz. We're seeing oil prices not really react massively to the skirmishes that we've seen over the past couple of days or so, but something to keep an eye on, especially with the talks supposedly happening in Doha later today. Just something we're going to have to keep an eye on.
Aber, thank you. Bloomberg's Middle East correspondent Aber Abu Omar for us in Dubai. Let's get perspective with Dorian Carrell, head of multi-asset income at Schroders. Dorian, good to have you with us. I mean, it does seem like we're still moving to headline risk, right? I mean, that hasn't stopped yet.
That's the thing, there's this 60-day period that everyone's talking about, but already we're part of the way through it, and it's becoming quite messy. You've got a meeting coming up in Qatar, and you've got the Iranians very determined to have some kind of control of the Straits of Hormuz, whether it's a toll, whether it's insurance costs, whether it's some kind of management fee, either together or not with Oman going forward. And that seems to be their position. So, I mean, our position on the multi-asset income side is that we're going through a gradual but messy de-escalation here. And this is going to go on, whether it's 60 days or not, there's going to be friction around the choke points around the world. It's a classic choke point. We think it's inflationary. And we think the inflation risk is really underestimated for income investors, and this is one of the reasons why.
So how do you position yourself if you think that inflation risk is there?
Well, I think you have to look at real income, inflation-adjusted income, and you have to understand that inflation in the States is running at around 3.5%. You've got inflation in the region here going forward as well. So if you have yields that are 5.5%, you have to subtract 3.5%, and also think about the fact you need capital growth going forward. You need to protect yourself because, there's been a lot of talk about how Kevin Walsh is hawkish. We think that's a misinterpretation likely by the market. He may well turn out to be far more dovish than the current consensus. He hasn't really defined what inflation is. He's talking about the trimmed mean. The trimmed mean is actually 2.4%, not 3.5%. He's changing the definition of 2%. Look to the left of the decimal point, whatever that means. And also in the statement itself, it's talking about stable inflation. Now, stability to you or me could mean different things. So, we do think that the backdrop here is inflationary. The debt position in the States is growing. You've got a 6% deficit to finance. A third of that comes at the front end of the curve. So, you put all of this together, and it's a slightly odd, this hawkish take by the market. And to go to your point on Japanese equities and the Japanese currency, maybe it's the dollar, maybe it's the Fed that will actually change perceptions in the market because, right now, Kevin Walsh hasn't said much. He's up at Sintra, I think, later this week. Then we've got the Jackson Summit at the end of August as well. And he's got opportunities to frame what he means. But meanwhile, he's got 5 task forces and a lot of vagueness, a bit of a cloak, a kind of veil of darkness here. So
do you look at the fixed income market differently, given this uncertain macro environment, given, where rates are, where liquidity is, which obviously is tightening?
Well, you say that, but, look at asset markets, look at credit spreads, and, to us, liquidity must be abundant. Private credit's done very well. It's got a lot of dry powder, notwithstanding the gating. Spreads are sub 300 for high yield. They're sub sort of 80, 70-ish for IG. And you've just got multiples in equity markets in certain areas very narrow but very high, and earnings expectations very high. Put all of that together, is it really a tight environment? That's something that we challenge. And we also think, even if you don't completely agree with us, think about what's priced. What's priced is a huge amount of earnings optimism. This idea that somehow policy rates at 3.5 to 3.75, with inflation somewhere around the same level, are tight, restrictive, and meanwhile people are concerned also about bubbles. There's a kind of discontinuity here. There's something that doesn't make sense.
And that's just it, the earnings optimism, given where rates are and where rates might be. Can you remain that optimistic? What's the risk of that?
I know. If we look at the hyperscalers, for example, it's Nasdaq's got mid-20s next 2 years annualized earnings expectations. So we think the expectations are a bubble as opposed to the multiples. And you think about what the hyperscalers are doing. They're changing their business models. They're going from asset light to asset heavy. And if you go to asset heavy, you've got a huge amount of potential supply chain issues, potential delays, and uncertainty about a business model model that you've never operated before. But meanwhile, the market seems very happy to extrapolate forward based on the past. So, to go back to the semiconductors, yes, they're going through a very sympathetic part of the cycle. Margins are sky high. But all of these things do come to an end, because behind everything, there is this circular financing. There's this kind of link between the private companies that may list and the hyperscalers and the neoclouds and the semiconductors. And there's a lot of revenues being promised here based on expectations of future profits, expectations of future productivity. And to go back to the Fed, it's the expectations of future productivity gains that are anchoring the idea that rates will be lower over time, but in the short term, he's surprised hawkish, but we think the market may be wrong.
In fixed income, where do you find yield? Where do you look for yield?
You have to be selective, you have to be global. A lot of funds talk about being global, but we look at EM local in our multi-asset growth and income strategy. That way you bypass credit, you get high inflation adjusted yields, places like Brazil, South Africa, etc. Australia, where rate hikes have actually happened, the curve is reasonably in good shape, and you can swap back investment grade credit into dollars for shorter duration, higher credit quality. So you go off the beaten track. You look at things like convertible bonds. Convertible bonds very out of fashion, but they actually help you if you're in an environment where inflation sticks or persists, because as equity markets go up, they lose duration, they lose rate sensitivity. And funnily enough, in European high yield, high credit quality, you don't have this private credit market beside it, potentially overspilling, giving you bad technicals. And Europe has a very sensible rate policy. The ECB is saying it wasn't an insurance hike. That's what Christine Lagarde said yesterday. And so we think, the stability, the predictability of markets outside the US is something to stand by. And, we even see opportunities in Japan, but obviously not on the fixed income side.
And in terms of the high yielders in Asia, the likes of Indonesia, the likes of India, would you be touching them?
Well, India is obviously trying to entice investors with new tax treatment in terms of the bonds, and so that does look interesting. India generally, as a market, we think has been overlooked both on the equity side and the fixed income side, but we'd probably be more interested in the equity side there. With Korea and Taiwan doing so well, China lagging, India lagging, that looks like an opportunity to us. But again, Australia really stands out, I would say, on the fixed income side in the region, and convertible bonds in Asia are the cheapest in the world. So we think you've got to be much more lateral. The old 60-40 approach, depending on government bonds, depending on the hedging properties, we don't think it's going to work. So it's an interesting setup that you've got for income investors.
You talked about seeing opportunities in Japan, but not in DGBs.
Yeah. If you look at banks, so banks are an opportunity in Japan, they're an opportunity in Europe and the US, all for very different reasons. You look at Europe, 20% shareholder yield for the next 3 years, earning stream going up, PE less than 10. In the US, huge capital market activity, a lot going on. 80% of lending in the US is through capital markets. Moving to Japan, price to book's pretty good. Yield curve has obviously steepened a lot. We heard from the previous commentator, rates going up, and they have a huge opportunity. So we would combine Japanese banks with industrials, and a slight broadening out in Japan now. We think it's a real opportunity. Their shareholder kind of a policy has improved massively, backed by the government. Takaichi's long-term plans, they may be expensive, but she's a very strong leader from our perspective. Looks like a huge opportunity. And Japan, possibly Japan's back, but obviously we need to see the yen stabilise, going back to where we started.
And of course, Takaichi's plans contingent on a weak currency, like where it is right now.
I don't think she would explicitly say that, but obviously it's helpful. And, there is a plan strategically for Japan, and, coming from the UK, from Europe, that's definitely something that we think is missing. But you can see the kind of industries that they're targeting there. You can see what the Bank of Japan's trying to do. It's got a very difficult hand to play. But, I think the Japanese will be very happy to see a movement on the Fed side, on the dollar side. But again, the strategic planner is underwriting, improving equity returns, improving shareholder treatment in Japan, so stands out.
You got to wonder the outlook for the Japanese yen, because under current macro environment, it's supportive of the US dollar. And with a pretty hawkish Fed, what are the chances that the yen can find its footing?
Well, again, we don't necessarily buy the idea that the Fed is hawkish. This is based on 30 minutes of not saying much, and the whole market has He was not asked his definition of inflation, he wasn't really pressed on the definition of two, and he wasn't asked what he meant by stability. So the three key things that you as investors really need to know. And to be fair to him, he's just taken over, he set up his task force, he obviously wants to think about the way the Fed communicates, the way the Fed uses nowcasting, real data and so on. There's a huge amount to digest, but thinking about what he's using as a measure, the trim mean, that takes out 51% of the inflation inputs.
But still there is rate differential to explain the weakness of the Japanese yen.
Absolutely, but it's generally the trajectory of rate differentials that are going to matter as opposed to the current state. So, if the market starts to believe that the Fed is not going to raise rates and UADA comes back with a slightly more hawkish tilt.
What are the chances of a more hawkish tilt for the BOJ?
We think that the US will solve this problem. Because we think that it's just odd the way the market has flipped so quickly to the idea that the Fed is hawkish, based on very little information. And at the same time, energy prices, notwithstanding the Qatar meeting, are going to gradually come down. And if you trim out the mean, if you look at what Kevin Walsh has said, his preferred definition is 2.4%. If you take his preferred definition of 2, why would you hike rates?
So Dorian, given everything that you have said and the environment that we're in right now, how should your portfolio be looking like? Has it changed?
Yeah, it has. So, our fixed income allocation is relatively low, but we have scoured the world for opportunities. We see them in Australia, we see them in securitized. We actually see some sovereign debt, very high quality because it's sold off because of the Strait of Hormuz. Convertibles we think are a huge opportunity now because people just don't use them. They don't think about them. They associate them with US growth, very high tech content. We have a much more diversified approach. On the equity side, you can be value and growth. You can be balanced in the middle. International value has outperformed over the last 12 months or so. European banks, to come back to your point earlier, has outperformed NASDAQ. Not many people know that. And at the same time, we think US value will start to outperform because people are worried about duration at the end of the day. They're worried about the Fed deficit, it's 6%. They're worried about balance sheet reduction. Walsh has talked about that too. If you reduce the buyers, you increase the supply, and people are not sure about the inflation outlook, that would probably tilt you towards value and to real income in credit. So we think there's huge opportunities here, but get away from the old 60-40.
Very quickly, what's the asset that's most underpriced at this point in time?
Probably European banks, but we would also say some energy sectors. Earnings expectations are high, but justifiably so off a very low base. It's probably your only hedge in the current situation. Look at what's happening today in the Straits of Hormuz.
Great perspective there. Thank you for dropping by. Dorian Carrell, Head of Multi-Asset Income at Schroders. Now, still to come this hour, Kotak Investment Banking's Deputy CEO will be with us as they reclaim the top spot in India's equity capital markets league table. Plus, Rystad Energy with a reading on the oil markets as Hormuz tensions simmer. Keep it here with us. This is Bloomberg. Following today, the European Union and China have set an October deadline to make progress on trade disputes as Brussels pushes to address its widening trade deficit and Chinese export controls. Both sides have agreed to tackle intellectual property concerns, pursue WTO reforms, and create a platform to monitor trade flows. The EU trade chief says Europe remains open for business while defending fair competition. Pakistan says it killed 29 militants in a ground operation and airstrikes on Sunday and Monday along the border with Afghanistan. The Taliban-led government in Kabul condemned the strikes, saying they killed 36 civilians, including women and children, while injuring 160 others. Violence on the border has intensified following a brief ceasefire over the Eid holiday in March. Keep it here with us. This is Bloomberg. In India's equity capital markets league table for the first half of the year, displacing last year's leader, JP Morgan, which fell to 9th place according to Bloomberg data. Joining us now is V. Jayasankar, MD and Deputy CEO of Kotak Investment Banking, which is a part of Kotak Mahindra Capital. Jayasankar, good to have you with us. First off, talk to us about how your franchise is different from your rivals in an increasingly competitive market.
Yeah, Thanks, Haslinda, for being very generous with your comment about Kotak Mahindra Capital Company. I would say that investment banking is an incredibly competitive business, and you need to be good on 4 pillars. First is equity research. Your research should be known globally for its quality. Second is deep distribution across all investors. Third is a deep domain experience of sectors, and there are at least 7 or 8 vibrant sectors in India. And finally, a strong ECM franchise. All 4, we have made some very, very heavy, deep investments over the last 10, 20 years, and that's probably the reason. And finally, I would be very thankful to all the large marquee clients who have given us the mandate and made our franchise what it is.
Well, the question is whether you can maintain the lead. Can you?
Future is something that no one can predict. All I can say is over the last 5 years, we have consistently remained at the top of the Bloomberg League table, barring some patches. And we typically aspire to maintain a leadership position, and we invest very heavily in people, in our technology, as well as in our client coverage. Ultimately, it's the clients who kind of vote for us if we end up bagging the league table position, and that's something that we keep heavily investing, heavily covering our clients, both on the corporate side as well as on the private equity side, because they are becoming very, very important stakeholders of the ecosystem.
I want to talk about the IPO market in India. It's been pretty muted in the first half. If you take a look at the ECM fundraising for the first half alone, it's about $14 billion, which is a far cry from $23 billion a year ago. What's your take on, the muted state of the IPO activity?
That's an interesting question, Haslinda. I will probably look at it with a different perspective. We have had a phenomenal ECM years in 24 and 25. Having done about $60–70 billion of activity, and IPO is roughly 1/3 of it. This year too, we had the same momentum. We probably would have done somewhere closer to $60–70 billion, but for the West Asia crisis, that really put the ECM clock back, at least for the IPO market, by a good 4 months, because IPO tends to be a longer lead. Otherwise, in the current year, we would have probably done, in our estimate at the beginning of the year, we thought we'll do probably $25 billion. As against $20 billion for the last 2 years. So we have an incredible pipeline, high quality, some very large transactions, heightened activity this year, at least if you look at filings, is probably 1.5 times higher than what it has been in the past couple of years. So I feel very optimistic that the next 6 months will significantly make up for it. But of course, the 4-month momentum has been a break for the IPO market.
And of course, the optimism is driven pretty much by some of the marquee IPOs coming online, like Geo Platforms, NSC. Given these huge IPOs coming online in India, do you think, it can beat the record which was set last year in terms of equity fundraisings?
Absolutely. If you look at the number of filings, as I said, it's at least 1.5 times more. If you look at the large filings, it's probably the highest compared to the past. The quality of deals, as I said, is very encouraging. And if you look at the large cap IPO listings last year, they have done phenomenally well. So if you look at the backdrop of large IPOs, and by large IPOs I mean a fundraiser more than, call it, $500–600 million, these IPOs have given listing gains on average of 20%, year-to-date return of about 40–45%. And that's phenomenal. It is a kind of backdrop that you probably expect, and you hope that momentum continues. Fortunately, there's been a correction in the valuation broadly in the Indian market in the first 6 months. And I therefore feel that the valuation backdrop is also highly encouraging for some high-quality transactions to be done.
You got to wonder, though, whether the market is deep enough and whether there's enough investor appetite to absorb what's coming to the market.
Haslinda, I'll put it this way. If you look at the flows, the domestic flows last year was $90 billion. This year, year-to-date, is closer to 48, and I think we'll cross $100 billion of domestic institutional flow. The FI flow is the one that's been a little bit worrying, because in the last 2 years, they pulled out somewhere closer to $35–38 billion from the Indian market. And therefore, if you look at the net flow, last year was somewhere about, call it $70 billion, adjusting for the FI outflow. And this year too, we expect this to be at least $70 billion positive flow just from the institutions. And our expectation of the overall ECM market for the current year remains to be somewhere about, call it 55 billion, closer to last year's 60 billion. So I think the flows are there. And I believe that FIs have begun to see that the Indian valuations are looking attractive. And as I said, they have participated in all the large IPOs. If you look at the large IPOs of last year of Misho, Lenskart, Grove, Tata Capital, and so on, they have participated pretty heavily, almost a 50-50 participation between FIs and DIs. And therefore, I believe that they will continue to stay invested. So I don't see flows being a concern. If the monsoons are fine and if there are no further geopolitical tensions around in the world, I think expecting India to do $50 to $60 billion of ECM trade, IPO market to be at the same level as last year is definitely feasible.
You talked about how the government is concerned about the foreign outflows. How do you think that can be arrested? This has gone on for quite some time now, and yet it continues to be so. Never mind that valuations seem quite attractive right now.
So I would tend to take a little longer term outlook. So if you look at the segments of participants who take the capital back, one large component are the private equity investors. So when they take a majority control or a minority control, it is very natural for them to exit over, call it a 3 to 7 year time frame. But equally importantly, the large private equity investors continue to stay positively invested because they continue to invest in India. So I would say that their investment outweigh the exits that they make in their prior investment, and India is a growing market, so that's very natural. If you look at the foreign promoters, someone like, say, a Singtel or a Hyundai, these companies have stayed invested in India heavily for 20 and 30 years. So when they sell 10% or 20% and take that kind of capital back, I think it's only natural that someone does that over a long period of, call it, a decadal of investment. So I won't really worry so much about it. I would probably look at a combination of FDI investment and FI investment, and I would try to see how do I increase the inflows while exits are a natural phenomenon.
So, Jay, you're not too concerned that foreign investors have turned more cautious. It's not possibly shape or change the way issuers view their approach to IPO pricings, for instance, timings of the IPOs?
Haslinda, if you look at the last 1 year I referred to, FIs have churned from the secondary market and invested heavily in companies that are highly differentiated. I spoke about a few names. And they continue to do that. So from a primary market point of view, FIs are equally important and have been equally active. What is happening perhaps is they are probably allocating more funds to other emerging markets, but churning out of stocks which they probably think are giving lesser returns than elsewhere. So it's not that they're exiting all counters. They're probably going towards more AI-heavy countries. It could be Korea, it could be Taiwan, and it's probably played out in the last 1 year. But as I said, since valuations have corrected in India, I'm very optimistic that FIs will come back, and we have seen that happen in the current year as well in many of the transactions that we have done, including, call it, Vishal Megamart, Blocks, Lenskart, Grow. In all these, we are seeing FIs investing as heavily as DIs.
And Jay, would you say that companies are now more realistic about pricing?
I would say that the market has got the right balance and discipline when it comes to pricing. And I did allude to a little earlier, Haslinda, that large caps IPOs last year, which is, call it, $500 million plus, they have all given a listing gain, a day one gain of 20% on average, and a 1 year return of about, call it, 45%. And that's incredibly encouraging. On back of it, if you look at some of the new age companies that we took public, like Lenskart, Grow, and Misho, we probably have sold $2.5 billion across these three companies, which is higher than their IPO size in a matter of, call it, 6 to 9 months. And that tells you that there has been absorption of that liquidity, that the listing gains and the returns continue to remain attractive. And that is what I think keeps us very encouraged as we look at the way forward for the IPO listings.
Jay, there's so much optimism in what you have said so far. What's the risk out there for the ECM market in the span of 6 to 12 months?
One, the corporate earnings have slowed down, and there is an increase in inflation in India because we are heavily dependent on crude. Our current account deficit had gone up. Thankfully, there is an element of peace returning in West Asia. So hopefully, it is a 4 to 5 month impact we will carry forward, and the worst is behind. So that is one risk if something were to really blow up in the geopolitical context. The second risk is the monsoon. We have had a subpar monsoon in the month of June. While we may not be as heavily dependent on monsoon as we were 10 years back, nevertheless, it will have an impact. So we'll have to watch out for the monsoon performance, particularly in the months of July and August. And finally, I think if the corporate earnings, as we expect, come back in about a quarter, I think some of these risks will be mitigated. Right. Otherwise, it's mainly the geopolitical tension and the monsoons.
And any reason for you to perhaps expand your headcount on the back of expected growth?
Haslinda, we operate only out of India, and therefore we always invest in teams, in our people, looking at a 2, 3, 5 year context, and therefore that is something that we have already factored in. So it's for us normal course outlook for human resources.
Jaya, thank you so much for your time today. V. Jayasankar, MD and Deputy CEO of Kotak Investment Banking. Just something to mark here. 2-year JGB auction, Japan 2-year bond bid ratio is at 4.82 versus a 12-month average of 3.74. Japan's 2-year bond bid cover ratio coming in at 4.82 versus 12-month average of 3.74. This is the bids are accepted at the lowest price of 1.4633%. It is selling 646.2 billion yen notes in its first non-competitive sale. Of course, when it comes to Japan, it really is about the yen story. The yen hovering at 162, levels we've not seen in decades. That Japanese currency under tremendous pressure on the back of a strong USD. Well, coming up, oil flows through the Strait of Hormuz are increasing, but our next guest says restoring business as usual traffic will take time. Rystad Energy Vice President Lin Ye will be joining us to explain. Keep it here with us. This is... Welcome back. You're watching Inside. Oil is heading for its biggest quarterly decline since 2020 as flows through the Strait of Hormuz accelerate. Morgan Stanley has cut its third quarter 2026 dated Brent forecast to $75 a barrel, while expecting prices to drop further next year. It says strong U.S. supply and weak Chinese demand also increased the risk of a surplus. Goldman Sachs earlier cut its price forecast for Brent for the last quarter of this year to $80 per barrel. Our next guest thinks restoring the usual level of traffic in Hormuz will take more than just rising transit flows. Lin Ye is Vice President of Commodity Markets and Oil at Rystad Energy and joins us now. Lin, it does seem like markets might just be underpricing the risk here, right?
I fully agreed. I think the market might be too confident or too optimistic towards a reopening of the strait.
Why so? How long will it take, and why will it take longer than people expect?
I think we are far from a free navigation, which we think is the standard of business as usual for the Strait of Hormuz. And very clearly that we're in the initial stage of the negotiations between US and Iran. And according to the latest fiction, we probably can say it as a mild escalation, but I think we have a long way to go.
But the MOU that's been signed, the sense is that it is salvageable, right?
I think, we can see it as, the U.S. is really rushing into an exit from the current war. And I think it gave Iran kind of leverage that I think it's not possible that Trump will restart the war again so that they can do whatever they want. And it's very clear that the Strait is still largely in control of IRGC currently.
So what assumptions are you making about supplies coming through in the next 30 to 90 days? I mean, how suppressed do you think it will be?
I think it will be a big game ahead of us because we know, in the past days, we have been seeing some of the rising transit, but then it's only the release of the previously trapped oil. It's not free navigation, right? Because we don't have the other necessary things that we need to see them happening so that we can call it a free navigation. Like the main shipping lane must be received, mine clearance. And also we have to see the insurance fee dropping significantly so that we are sure that there's no additional war risk premiums. And those things never happened, so we think it will take longer time. And I think between these two parties, a lot of issues haven't been addressed yet, like the nuclear weapon issue is still the major one,
right.
And it will take longer to even reach there.
But Lin, the question is really, how clear are we about how much is still stranded in the Gulf?
I think there are more than 400 vessels are still stranded in the Gulf, and it will take more days to release those. But we have seen the kind of transit slowing down significantly after the attacks last week.
And in terms of the dark vessels, we know that they've provided some respite for the world. What do we know about these dark vessels and how many are getting through?
I think probably only less than half of them have managed to pass the strait, and the rest are still in Gulf region. And also at the same time, we have also seen some of the so-called east to west transit. That means the ballast ships also enter the Gulf to be loaded with crude oil from the Gulf producers. That is a good sign, but it's only the more bold and optimistic ship owners can do that. So we still need to wait and see. More of the ship owners have made up their mind to enter the Gulf. Only by then we can think the navigation is achieved again in the strait. So in my mind, it will take another few months to reach the destination. And also we need to monitor the negotiations between these two parties. I think the U.S. still has the leverage that they can cancel their sanction waiver anytime if they want to, regain some of the power in the negotiations. But we need to wait and see.
Customers in Asia, Lin, have they changed their behaviors in terms of where they buy their oil from, their crude from? I'm just wondering if diversification has really become the name of the game right now.
Yes, crude diversification is really providing a big strategic lever to all the Asian importers. And at the same time, also some of the crude stock down also helped with the current situation. But we know that it was only temporary, because we cannot forever leave off the inventories, right? But then again, also the demand destruction in China was also helping with the ease of the shortage of the supply. And so far, I think the Asian countries are well supplied, even with the historic supply disruption. Yeah, so I think that's why we are seeing very weak oil prices even before the ceasefire and even before the negotiation started.
You talk about demand destruction in China. Do you see China's demand coming back online?
Actually, I'm in Beijing currently, but I haven't seen any signal of the demand recovery yet. But we are entering summer. So some of the holiday vacation travel will apparently boost the road transportation. But again, for China, it's a different story because China has vast electric vehicles, not just passenger cars, but also trucks. So the boosted demand will not be converted directly into gasoline demand. But then in Europe and the US, it will be more significant and pronounced that the summer's travel season will boost oil demand significantly. That's why we are thinking, supported by the stronger demand, we think third quarter oil price still have a lot of upsides if we need more time to see the reopening of the strait.
Lin, at what oil price do you see China perhaps accumulating barrels?
Actually, in the first 4 months of this year, China has been accumulating oil inventories. But then we have the disruption, and China decided to tap into its commercial inventories. And that's why China is living off the inventories right now. But then the level is lesser than we expected. It's less than 1 million barrels per day of the inventory decline. So with the rich ample inventories in China, I think it's not an issue in the short term, and China can survive longer, even with a closed strait.
Lin, thank you so much for the assessment. Lin Ye of Rystad Energy. Before we go, let's take a look at markets and where they are. We have Asian equities on track for their best quarterly gain in 17 years. That's a massive gain. Tech stocks, of course, leading the upside and optimism over that AI trade. The MSCI Asia Pac Index currently up by about 0.9%. The Hang Seng Index in the opposite direction, down about 1% right now. Of course, when it comes to the FX space, we're keeping an eye on the yen sliding to its weakest level against the dollar since 1986, extending its losses to trade past 162 per dollar. Take a look at that currency right now, down about 0.1% versus the USD. We have the markets poised, waiting for intervention from the Japanese government. And that is it for Insight. Horizons Middle East and Africa is up next. Keep it here with us. This is Bloomberg.